Jeffrey Dorman, Chairman and CEO of Institutional Real Estate, Inc. And welcome to our fourth quarter and year-end 2022 ODCE Index Update webinar. There have been some pretty dramatic shifts in ODCE performance during the latter part of the year, so we'll be focusing intently today on some of the drivers of those changes. At any rate, thanks for joining us. Keep in mind, we'll be recording this session. So if you or one of your colleagues wants to review the recording later, it'll be available in a few days. We'll send you a link. So look for that in your email inbox. Also remember that throughout the webinar, you can pose questions for our presenter at any time by clicking on the Q&A icon at the lower right-hand corner of your window and enter your questions. You can either do that as yourself, in which I recognize you as the source when I pose your question to our presenter, or you could pose your question anonymously if you prefer not to be acknowledged or identified. Either way is fine. And we'll try to respond to as many of those questions as we can. And as always, our partner in producing these quarterly updates is IDR, the manager of two open-end ODCE index funds, one for institutional investors and one for accredited high net worth investors that seeks to track the performance of ODCE by a margin of plus or minus 12 basis points. I hope I get that right, Garrett. I always screw that up. But our presenter today, as always, is Garrett Zadolchak, the portfolio manager for IDR's two ODCE index funds. And prior to joining IDR, Garrett was a senior consultant with Cortland Partners, which is now part of Stepstone. At Cortland, Garrett was a member of the investment committee and participated in all decisions related to investment program and investment manager selection and performance measurement. And since now at IDR, his entire focus is on investing in ODCE funds, I can't think of anybody in the country better qualified to help us all understand what's going on behind the numbers each quarter. So Garrett, the floor is yours.
Thanks, Jeff. As always, great to be here. If you remember a couple of years ago when we talked about maybe doing this, my biggest concern was, what are we going to talk about every quarter? Real estate can move slow, but it's certainly been a pretty busy couple of years instead. So, I thought maybe I'd spend a minute before we kind of get into the agenda, as we usually do, but talk about kind of some recent events with the banks. I found it pretty interesting. We've heard from basically all the ODCE managers at this point, and there's been a surprisingly small exposure to the banks, given some of the other things that we've read. In total, the kind of cut to the chase, the total exposure across $350 billion of assets was less than $1 million in accounts. Most of those were obviously insured by the FDIC, but the FDIC stepped in anyway, so no losses. And then, on an indirect basis, there were some letters of credit, for tenants and a couple small leases, but I mean, virtually no exposure if you really think about the size of the market. So, obviously that was a great thing. It did get us thinking a little bit though, obviously, late last week into early this week, it, started to feel a little like 2007 where you're kind of thinking about accounts. Are they safe? What banks are safe? What aren't? But the more we looked into it, I think the more we realized it's it rhymes a little bit, but it's not nearly the same. Really in 2007, all the major banks, the largest on down, were having liquidity challenges because they all own the same toxic subprime loans, and that's really what drove that liquidity challenge. I think this time around, it's a very different driver, certainly rising rates, and we'll talk about that throughout. Rising rates are certainly an impact or having an impact in the sector. But I think the three banks we saw with challenges, at least to start, had a lot of exposure to either venture capital or early stage kind of businesses or crypto, which kind of makes sense that they would be the first to kind of see some illiquidity challenges, since those sectors don't really create income or profits. But enough there. If people have more questions on that, we can certainly delve into the banking sector more. But not saying other banks won't have challenges by any means. Just that I think it's different this time, certainly. And like SVB, for example, had more than 90% of their accounts were corporate or non-retail accounts. So capital can move a lot quicker there, for example. So, without further ado there, maybe we'll jump into the agenda then. And I will figure out how to share my screen. All right. So as usual, I thought we'd start with the agenda. Market update. This time around, we'll do a full year in review. So typically, when we refer to sections or changes, we'll look at least a 1-year change for 2022. Go back to fundamentals. Where are the drivers of performance or underperformance? And then third, as always, capital flows, Qs. I know everyone's interested in seeing what liquidity looks like or the challenges there. So, year in review. To start, ODCE as a whole added about 275 properties. Occupancy is virtually unchanged. One less fund in the index. It was a very small fund. We covered that earlier in the year in the first quarter. And, leverage, again, slightly up, which, I think makes sense with the little value decline in the markets, but largely unchanged. So leverage still at 23%. In terms of the sectors, is clearly where the biggest changes happened. Industrial continued to grow, apartment continued to grow, while the less attractive sectors, office and retail, declined. Other also continue to grow, and NCREIF is making some changes there as well, I should note, in terms of what is considered other and what's covered in these underlying sectors. I think, from a regional standpoint, the West remained flat. The South grew, given the path of development and costs. And then ultimately the East was virtually unchanged, and the Midwest lost about 0.5%. So certainly seeing capital to a degree go into these growth markets, although probably a little less dramatic than you would think compared to the sector transition. And that sector transition, over the longer term, since 2012, has been a lot more dramatic, certainly in the last kind of 4 years, pre-COVID, really starting with pre-COVID and the retail decline. But it's been pretty dramatic. Industrial is up 15%. Apartment is up 3%. Tends to hug the benchmark a lot more closely, or at least the underlying funds. Weightings tend to hug apartment really close. And then office certainly declining quite a bit. We looked at really this decline, especially the period of these really steep declines over the last kind of 3 years. And it was kind of interesting. About 80% of the change in that of the sectors was due to value change, rather than just massive buying and selling. Certainly, there's been more focus on buying industrial, for example, and selling office to a degree. But a lot of that change is really from the value change as well. For the change of value, okay, so there you go. I think the other thing is, as we'll talk more about capital flows, it is starting to level off a bit. Industrial seems to have peaked a little bit, and then office, I think, will certainly probably decline the most if you think about where we expect values to change the most. And then retail is leveling off as well. kind of wanted to, take a step back to in this discussion and talk about the sectors. We're hearing a lot about denominator effect, certainly from investors and the challenges they have and their need for liquidity. So here is the kind of equity market. Certainly bonds were down as well. 2022 was, I think, only the third year since the 20s that equities and bonds were down for a full year. But the public market certainly sold off at the beginning of the year. Whereas I think the broader S&P is coming back a bit. S&P was up at the end of last year, about 7%, and is slightly up this year, I think about 1%. So that should help some denominator effect a little bit, although it's only just starting, I would argue, to factor into the numbers. So a little bit of a bright spot there, although, certainly not a huge movement. Getting some questions going backwards. Can you speak about what subsectors within other have driven its percent increase specifically? So I'll go back, maybe Jeff here, if it makes sense. So I think in other, self-storage is about half of other today. I think it's going to be broken out going forward within NCREIF, and it is certainly a huge driver of that sector. It's also, I think, clearly its own sector, whereas sometimes we'll see life science, for example, a bit in office, and it's kind of inconsistent if it's considered office or other. Kind of same can be said for single family rental, where a lot of times that can be included under apartments, but self-storage is clearly the biggest. And then there's some of the other sectors, I think, following up, behind that. And interestingly enough as well, I think hotel is virtually out of that category. I think there's only 2 or 3 hotels left in the whole index. And then I think John asked, the 273 new properties come from acquisitions. Yes. So John, no new funds were added to the index over the past year. So those were all acquisitions. And in fact, I think if we look through, there's probably more than that because one fund left the index. So there's probably more acquisitions than that. And then I think Edgar is asking about, so going forward, maybe to the REIT question, does ODCE have a natural lag to public REITs implying further reductions? The short answer is sometimes. The REIT market and equities market, I don't have a slide in here on this, but we do show a slide. There tends to be a lot more sell-offs. So the REIT market has always gone down before an ODCE downturn, but the REIT market has gone down a lot more often than there's been an ODCE downturn. So it's not a good indicator at all as to whether the ODCE market is going down. We see a lot of false negatives, but in I would argue, in a prolonged downturn or a prolonged challenging market, it can at least be a kind of an indicator that values may be declining. But you can see, like, the public markets are recovering. Does that last? Does that continue? Is there more to come? Do rates keep going up? I mean, those are all the challenges we're trying to answer, and it'll have very big impacts on the future of not only the public markets, but the private markets.
Now, Farah Syed Unis also has a question. Is affordable housing going to be a new subsector in the ODCE?
I don't believe they're specifically defining affordable housing. I think there's a lot of definitions as to what that means and different views on that. They are breaking out housing a little differently, but I don't think it's a specific sector in and of itself, but there is certainly affordable housing in ODCE.
And then some anonymous attendee asked, will slides be shared with attendees? We always share the slides with attendees. You'll get a link to a recording, and you'll also get a link to download the slides. So we always provide that to you.
So with that, and please, love the questions. I think they're great. It's how we think about, things to answer and talk about here every quarter. So appreciate the questions. In terms of jumping into fundamentals, and performance and, what's driving that performance. So the blue line here is showing you the property type dispersion, meaning the best performing sector versus the worst performing sector on a trailing 1 year basis. You can see how high that peak got towards the end of last year, or really the middle of last year, and started coming down a bit. Kind of makes sense too, with all returns coming down a bit. But you'll also notice the funds really followed suit in that there was a wide dispersion of performance, and that was largely to some funds were way over or underweight various sectors, and that had the biggest impact on performance. I find that interesting because in the last cycle, you can see the fund volatility in the blue line, or I'm sorry, in the green line, spiked significantly, as you would expect. Markets got more volatile, fund performance got more volatile, but it wasn't driven by the blue line. It wasn't driven by property, allocation, meaning what were you over or underweight. It was really driven by what properties you owned within those sectors. And I think that's, a big message we have going forward, that just looking at sector performance, just looking at regional performance doesn't tell you enough anymore, because regional performance by sector matters more now. It matters what regions or what submarkets you're in. It matters what subsectors you're in within these sectors. So it's, in our view, it's going to get a lot more complicated before it gets easier, if you will. And there's going to be a lot more dispersion. And John McClellan's asking, is fund dispersion dollar weighted? It's by fund, so it could be a very small fund that's the top performer or the bottom performer, and vice versa. So there is no kind of taking into account which funds are bigger or smaller. It's just the best performing and worst performing fund. And so kind of getting, to that kind of contribution of return. So these are quarterly returns, and you can see the total, the bars stacked up gives you the total quarterly return, and you can see the kind of drivers of that return by property type. So as you go back, you can see that it was fairly even or fairly close to the weighting percentage, within the index, where office was the largest, for example. The yellow there you can see was a big part of returns historically. And then you can kind of see the demise of retail, if you will, or the challenges as we kind of went forward and saw some negative returns out of retail and even some of the other sectors in kind of the early 2020s. And then you see the huge pop of really industrial, and then to a second degree apartment, driving the vast majority of performance over the last kind of 2-3 years. So, coming off of that, I think as you look, certain things could be viewed as much more expensive today than they were at least yesterday, for sure. And then you can kind of see on the downside here, in the fourth quarter, the -5% return Really office was the biggest component of that, but you can't overlook the industrial and apartment exposure there. Given retail's declines and lack of growth, we'll dive into this more historically in a few slides, but retail was actually one of the best performers. Retail and other did actually quite well compared to the other sectors in this last quarter.
There's a question, Garrett, also. Can you discuss the BREIT situation as well as PIMCO Columbia default? Is this the beginning of a trend or just two one-offs?
So I think we're getting at assets going back to the lender in the office sector. I think office, and again, it's generalizing, I think can be really dangerous and is going to be more and more dangerous going forward. But certainly there's a fair amount of office in this world that is lower quality and doesn't have a lot of demand. And so if you're a levered owner, especially a highly levered owner of those assets, you got to make the decision of how much money do I have to put into this asset to make it viable, to make it attractive to tenants, and what's the return on that capital? And that's where I think the math gets really hard for some of these owners, and so they probably will give them. You'll probably see a lot more of those types of assets going back to the bank. But again, I think it's capital structure, it's asset quality, it's asset location. So you're not going to really be able to generalize across the board, other than saying, I think, there's risk in the sector. At the same time, the truly high quality, good assets and good markets are actually achieving record rents in some cases. So again, there's going to be a really wide dispersion. There's going to be a lot of capital lost on the levered kind of higher risk side of the equation, I think. But, I think on the other side, there could be some value opportunities as well.
Anonymous attendee asks, by all calculations, private real estate is priced at the highest valuation levels in history. So where does the performance come from?
Well, again, I think we're looking at by all calculations, right? So we're talking about apartments and industrial, office, but the peak of office was 3-4 years ago. It's really been declining since then. And so I think there are some really expensive sectors out there. And I'm not discounting office and retail, but they haven't climbed nearly as much as some of these other sectors. But vice versa, I would say that growth or that value has been driven by growth. So NOI growth, and we'll touch on this in a minute. The NOI growth driving those values has been at all-time highs too, largely, or at least since the last time we saw meaningful inflation in the in the 70s and 80s. So yes, values are much higher. Rents are also much higher. And, the question in our mind is, does that growth continue? At what level? And, what does that mean for values, obviously? But I think you also have to think about values relative to the risk-free rate and yields, which we'll talk about here in a minute too. I mentioned performance. I kind of start here in terms of, where's that 1 year return? And then secondly, where did the fourth quarter kind of value change happen? So you can see office was down about 8.5%. And by the way, this is an unlevered return, right? So this is unlevered value change. If you're 50% levered, that number doubles, for example. Obviously, ODCE is not 50% levered, but to give you a sense of how dramatic and how wide returns can be, it really comes down to leverage as well. You can see, I think on the other side of the coin here, industrial, still a very strong 1 year return. It was up 12% over the last year, but down about 4.5% for the quarter. Industrial is the lowest levered property type in the index as well. It's single digit leverage at the asset level. So, again, less impact on leverage there than other sectors as well. So getting back to office, specifically wanted to pick on office values and where they are today. You can see, we really started seeing the decline in value change with COVID. It was relatively flat to slightly up, really just kind of keeping up with NOI growth. And now it's coming off, fairly substantially. And again, I think by market, by asset, by tenant base, that dictate a lot of different value changes over time. From a high level, even just looking at CBD versus suburban office, you can see there's been a much bigger change. So suburban office, this is going back to 2019. Suburban office actually had a little value growth coming out of COVID, and values were up a little bit. But you can see the CBD office, it's been a downward trend for the last 3 years, and arguably even a little earlier than that. So, again, peeling back the layers within real estate, it's not, I see this word a lot, democratizing real estate access or access to real estate. Real estate is not a democratized asset class. Every asset is different. The outcomes are different. And so you can see even at the first layer back, there's very different outcomes in terms of performance.
Anonymous attendee asks, piggybacking on the last question, do you attribute between cash flow and yield effect to determine value performance drivers, either as contribution to return or absolute dollar?
I guess the question is, yes, we look at cash flows and the corresponding yield of those cash flows, to come to a cap rate, value determination, right? So I think the question is, are those driving, these returns? And yes, absolutely, in a big way. Arguably, I think industrial, we'll touch on it here. Industrial has the lowest cap rate in the market, so it's arguably the most expensive. At the same time, the expected growth in rents in that sector is much higher than say office. So arguably in 5 years, you'll have a much higher yield, and it's a much better buy, I guess, is what that question's getting at. The question is, does that happen? You're buying, future performance, basically. So delving down a little deeper into, the value change in the fourth quarter, especially going in cap rates, the biggest actual change in going in cap rate was an apartment. But again, that was offset more by, so the value change wasn't as great in an apartment versus office, for example, because the outlook in terms of growth and NOI in apartment is clearly much higher and much better. It's been a much better inflation hedge with rents and single tenants going forward. So you can see overall the cap rate went up about 25 basis points. And again, I think it's really important to focus on apples to apples. So this is going in cap rate. This is current yield. This is not pricing in what's going to happen in the future when you look at this number specifically. And then, exit cap rate is typically a 5 to 10 year hold view. So you can see exit cap rates 5.2%, because over the next 5 to 10 years, the view is that NOIs will grow, for example, and have higher yields in the future. So, but correspondingly, those were up about 25 basis points. And then the discount rate. So, again, I think a big reaction to higher Treasury rates. The discount rate is going up as well. It went up a little higher, almost a little over 30 basis points. And again, on the bottom, you see the impact by sector, and you can see industrial actually had the highest change in discount rate, probably given that it's at the lowest going in cap today.
Yeah, the person that asked the prior question clarified it by saying the question is specific to the appreciation component attribution.
Jeff, I'm trying to remember the last question. I still don't understand it.
Hold on. The last question was piggybacking on the above question. Do you attribute between cash flow and yield effect to determine value performance drivers, either as contribution of return or absolute dollars? And they're talking about appreciation component attribution.
Well, yeah, both, right? So we're looking at performance on a net. So that slide is specifically looking at performance net of fees. So it includes income and appreciation in that slide. You can certainly break those things apart and look at, who has the highest income versus the highest appreciation. But, today, if you look at the trailing 1 year return, income's around a 4. So, over the last year at a 6% return, income's been, more than 50% of your total return. So it's had a bigger impact. Here is cap rates by property type. And again, we kind of want to go back to pre-COVID numbers, kind of looking at where do we start going into COVID and where are we today. You can see retail is actually higher. The only sector that's arguably higher than where we started, although office probably about even, just got even this past quarter. So retail and office are certainly highest going in yields. The challenge and question is, what's that future yield look like? Whereas you can see that huge decline in cap rates for industrial in the blue line, but it is also offset or certainly predicated on future rent growth. And then obviously apartment, you can see kind of mirrors the index probably the most closely.
So James Laufenberg asked, do you have the dividend yield net of fees for the ODCE index? What the payout rate?
We do. It's not something ODCE releases though. I don't think it's something we publicly release, but obviously we do see the dividend rates, and it's not the income yield, but happy to follow up after that.
In comparison to the income return of 4%, what has been the dividend yield for ODCE? Again, same question, but you're not going to respond to it?
Yeah, I don't think we publicly release that number. It comes out to a pretty wide gap too, I would say, between funds.
Okay, so it varies a lot between funds.
It does, yeah. Distributable is a much different number.
Curious,
Yep.
Gary, why would NCREIF be sensitive about disclosing that number for the overall, for the whole, as opposed for on a fund by fund basis?
Oh, well, they just don't. I don't know if they are or not, frankly, Jeff. I just know they don't distribute it or don't
Publicize it.
Yeah, and frankly, I just don't think it's appropriate to release our product dividend yield publicly. I'm happy to do it one-on-one, but
okay. So if somebody wants to know, can they email you?
Sure.
Okay.
Long-term spread to treasuries. I think this is kind of also getting back to that question, at least dividends and yields. So a little bit of complicated chart, but 1x is basically the historical average, if you will, of the spread to treasuries. So the single B spread to 10-year treasuries, or current cap rate spread to the 10-year treasury. You can see in prior cycles, the single B spread has historically kind of predated the cap rate decline. And then you kind of look at today's view, we saw that as well, although the single Bs have arguably come back a lot quicker than cap rates. So I think, as we look at the market today, one of the questions is, do cap rates have to move a lot more, or do Treasuries come back down a little bit over time, or both, arguably. And I think that's what the market's wrestling with quite a bit right now, especially with recent, recent events. As we look at the impact, though, this still looks a lot like the 70s when we had a lot of inflation, and real estate, was really, if you will, bid up and highly valued because of that kind of inflation protection it provided. So I think there's still a lot of questions out there. I understand the questions: where are values going? Where are the markets going? But frankly, there's, I think, across the board, a lot of uncertainty and a lot of investors saying, look, I would take today's value, certainly to create some liquidity, but at the same time, we're not seeing a huge rush to get it if it's not available, because investors are enjoying their income.
Anonymous attendee asks again, can we get a replay of the call and the slides? Yes. Everybody who registered for the program, whether they actually attend or not, will get a link, an email with a link to the recording of the call and to a download of the slides. So everybody will have access to the recording and to the slides. So if you missed a part of it, don't worry, you'll be able to catch up. Also, if you have colleagues you want to share the information with, you can share the recording with them and share the slides with them. That's perfectly fine. We're here to be helpful. We're not, and again, there's no charge for these things.
So Jeff, kind of tying off to the spread to Treasuries, I thought it'd be interesting to look at we haven't shown this slide before, the weighted average cost or interest rate in ODCE, and recognizing obviously there's 23% leverage, but the cost of debt has certainly gone up. I was a little surprised. I mean, this scale is pretty small. If you see, kind of going into COVID, pre-COVID, cost was, call it 3.9. We're only up about 35 basis points from pre-COVID levels. So the cost of debt is not significantly higher today. I would, and the question's asking, I would say though, there's about 75% or 70% fixed rate debt in the index. So this reaction is really from that 30 basis points of floating rate debt, which again, it is more, meaningful. Obviously the floating rate debt's a lot higher than the fixed rate debt, but, typically the term, is pretty good. So here's the kind of debt maturity schedule of ODCE. Only about 10 to 13% comes due every year. So we have a very fair amount of time of, frankly, some real stability in terms of cost of capital in the index until we get to about 5 years out.
Yeah, and Tim Wang had asked, is this the cost of new debt or the overall cost of debt for ODCE? And Brian Thomas wrote back, overall cost of debt of ODCE.
Yeah. There's a weighted average.
Weighted average capital cost.
Yep. I'm sure everyone would love to borrow at 4% still today. I know I would. And then Jeff, before we go on to capital flows, I mentioned inflation and NOI growth. So obviously the NOI growth in dark blue here, you can see has actually caught up and exceeded inflation as it spiked coming out of COVID. And again, I think this is the one place that investors are saying, does this stay at 6.5%, or does it come down, or does it go negative? Kind of what's the outlook here? And it's certainly, I think, very different by sector, by subsector, by market, and submarket. So, I think this is what's going to be driving a lot of return difference in the future. And this might even be driving, decisions to give assets back and things in the broader market, because if there's no growth and no leasing potential, it doesn't make a whole lot of sense to put money back into some of those assets that I think you're going to see, in the Wall Street Journal and people ask questions about. But again, it doesn't mean, everyone owns 60-70% levered office either. All right, cash flows. So we show it two ways. This is just the absolute net cash flow in and out of the market. So includes everything: contributions, distributions, reinvestment, all quote unquote cash flows. You can see the top and bottom shows the actual inflows and outflows, and the line shows the net effect. And you can see it's kind of zigzagged pretty good, over the last 2 years, coming out of COVID, where we saw some, fairly steep negative flows. We really only saw about $2 billion in negative outflow this quarter, largely because of Qs, which we'll get to. But you can see the inflows, came down fairly sharp. But the outflows came down as well as funds reduced their payouts or created exit queues. In terms of actual acquisitions, dispositions, very low, arguably, although I would argue this is kind of a holdover, because sometimes deals, take 6-9 months to close. So these deals that were acquired or disposed of were largely probably in process and, agreed to at pricing that was maybe agreed to, 6 months or 3 months earlier.
Momtaz Kalani is asking, how big of a reduction was the $2 billion cash outflow from 2021? So
I think in a full cash outflow, there was up to $7 billion of payouts in a quarter in 2001. But there was also $7 billion of inflows, at times as well. So you can see kind of on a net basis, largely inflows and outflows over the last year have been really predicated about just, the absolute dollars of incoming and outgoing money. Because as you look here, you can see, other than 2Q22, the acquisitions and dispositions were fairly closely aligned.
Glenn Kakovic asks, does the proliferation of interval funds alter the liquidity risk in the private real estate space?
That's a great question. I think interval fund, or we've probably, seen the private REIT market more closely, where we've seen volatility of cash flows pretty high. I would argue, though, that the institutions, have probably had some pretty high outflows as well over this period. So I think, on the pure core market, I would say I think it's been reduced. If you look at the broader market, those funds have gone up the risk spectrum largely to include kind of core plus and non-core as well. So I think they've been transitioning out of core for a while, to try to achieve higher returns. So I would argue probably a little bit, you have individuals making probably more decisions, but it probably depends also on, the sectors, broker dealers versus wealth management, et cetera. We can look more into that, though. That's a great question.
And do you track releasing spreads by sector? Are industrial mark-to-market rents coming down?
Yeah, absolutely. We're watching that closely. Look, we're even seeing, I think, industrial development deals getting idled, which I think tells you a lot, right? If new development is too costly today compared to expected rents. So yes, the mark to market is definitely coming down. I would argue, we saw a period of time where an asset with a 2-year lease was priced higher than an asset with a 10-year lease, because the view was I only have 2 years before I have to release that asset at a much higher rate. And the risk, again, market's pricing, upside, not risk downside. That I would argue, has stopped or at least largely reversed at this point. From a transaction summary standpoint, I think, again, this is probably no surprise. Office, or maybe it is a surprise for everything we hear about office. Office was the biggest sector sold, about 800 million of office, mostly though in Texas. And again, I'd probably discount some of the numbers I'll give you in a second here, given the lag that can take place. But the dispositions averaged about 3.5% below their current carrying value. So again, pretty close to their actual carrying value, which I thought was interesting. Again, you can argue about selection and which ones are sold, but again, there is some transaction activity. It was 800 million, so it wasn't nothing. Also, those values were about 11% below their peak values, which was roughly about 4 years ago, where we saw those assets at peak values. So again, off highs, but fairly close to current carrying value. In terms of the acquisition side, about $1.3 billion of industrial was purchased. About 300 million of other. That 300 million of other was largely self-storage and single-family rental. So, I think the last slide everyone likes to see, redemption queue. You can see redemption queues increased significantly. Every fund in ODCE, or virtually every fund in ODCE has a redemption queue at this point. There might be one or two small outliers, but most, if not all, funds now have an exit queue. And they range in size dramatically. Obviously, about 10% of the market is in the redemption queue. And we'll see what that means for the first quarter here, because there probably was more requests here in the first quarter for March 31 payout, and we'll see what gets paid or not paid. In perspective, though, this close to 10% number, is still about 2/3 of the GFC. So in the GFC, we saw about 15%. Redemption requests at the peak. And interestingly, it only took about 2 quarters though for that to completely reverse and go from a 15% exit queue to a 12% entrance queue. So it happens quickly when it does happen. I think, most of this money, I saw a good quote. I definitely give credit from Joe Hazelby, who said, I think sellers today want yesterday's pricing and buyers want tomorrow's pricing. So, got a little bit of a bid ask certainly going on, but I would argue some of this queue, or a good portion of this queue, would reverse if the denominator effect went away, or values got to a point where people didn't want to crystallize their exits.
So somebody asked, what was the average going in cap for the industrial acquisitions in Q4?
I'll let Brian answer that via text.
Okay, and then Glenn Kekovic asks, there's been much discussion on if the pricing on venture capital companies is realistic. Can you discuss real estate pricing? Is it realistic?
Yeah. So and I am no means a venture capital expert, so I'll leave that one alone. But in terms of real estate pricing, is it realistic? I think it's very dependent on the building, the sector, the market, and it'll be interesting to see what sells here in the first quarter or not, because I think that's going to create some, real views on values, because, appraisers are looking for comps, right? So what does sell, I think, will be a bit enlightening either way. I think, you have a lot of, again, buyers pricing in the worst, and you have sellers pricing in the best. So I think, tell me where the Fed ends up with interest rates, tell me where inflation ends up, and tell me how kind of some of this banking stuff resolves itself, and where rates go, and I can tell you who's right. But there's certainly a wide outlook on that today, and it's going to, probably take a couple of quarters to figure that out and sort itself out.
Both Linda Kelman and Kevin Higgins have asked if we could present a slide, and maybe we can do this in the update, showing the Qs to include GFC, so they can compare what's going on today with what was going on in the GFC. Can we do that?
We've kind of talked about this in the past. We generally don't release that kind of historical data that far back. We view it as a fairly proprietary data source. That's why I give you kind of some quotes, but I don't think we've ever released the broader numbers.
Well, if you feel like it and you rethink your thought, it wouldn't be bad. People would appreciate it if you could provide a slide.
We can't share everything, Jeff. We share as much as we can.
All right. My good friend Phil Baca has a question. When do you think Q1 fair market secondary pricing for ODCE is? As an index rather than any individual funds, and meaning post Q3 2022 peak and Q1 2023 NAV movements. Phil obviously is engaged in secondary markets. It's an important question for him.
Yeah, and I think it's a good question. We're more of a market taker than a market pricer, I would say. We do, as Phil knows, buy, but I think we'll wait and see where the sellers are. In my opinion, it's more about what sellers are willing to take for liquidity today, rather than buyers needing to transact. Given that, again, I think most investors are kind of at their allocation. So I think it's a great question. I think we'll see where things shake out and how important liquidity continues to be or not be. I think to kind of expound on it, to date, liquidity, I think given the discounts that have been out there, I think liquidity hasn't been all that important to investors, which is great because there's no forced sellers, and it's a pretty orderly market. So we'll see.
And last question from Glenn: what drives the directional change in NOI more, GDP or CPI?
That's a great question. I think you'd probably have to start looking at it more by sector, because I would argue that CPI is driving things like apartments probably a little more heavily, whereas GDP is probably driving the commercial sectors a little more, and maybe even more like office or things like that, or even life science, arguably, right? Because the more the economy grows, probably the more venture capital money there is and things like that for those type of sectors. So on a weighted basis, I wouldn't venture to guess, but I bet you could look at sectors and really say one drives one more than the other.
And also, I guess it would have a lot to do with the lease structures in place and the market environment which those leases were created as to how severe the rent stop, the stops are.
Yeah, right. I mean, after about 10 years of very low CPI, people stopped putting that in the lease structures, right? And then it became meaningful again over the last year or so. So absolutely, that's a good point, Jeff. But it seems like there's not a whole lot of CPI linked leases anymore.
Okay, we're drawing to a close. So if there are any other questions, let's get them on the table. And you're welcome. All right. So again, Garrett, thank you and your team for the work that you put in. I know these things aren't just come right off the tip of your brain. You need to really dive in and do some work to massage these numbers and get them in presentable form. So we really appreciate it. Sorry, we can't answer every question everybody has directly. NACREIF is kind of a touchy subject in the sense of how much they're willing to disclose. And that's in the interest of all participants to keep the information flowing and keep it robust. But we appreciate your input. We had a lot of interaction with the audience this time. We appreciate that. And we look forward to our next session, which will be reviewing Q1 2023, where I'm sure, unfortunately, we're probably bound to see some continuing trends that we observed in Q4.
Yeah, it'll be interesting, and I look forward to doing this update again with you, Jeff, next quarter. So thanks.
So much. Thank you, Garrett. Really appreciate it. Thanks everybody for tuning in. Again, you will get slides and you will get a recording. So hang tight and we'll get those to you in the next week or so. Okay, take care, everybody.